Hello friends, this is Sahas Academy. We are presenting India Macro Market Analysis. It covers global and India-centric events impacting currencies, interest rates, equities and gold. We want to thank Dr. Sukhendu Ghosh, Mr. Mataprasad Pandey, and Mr. Harish Madan for their contribution for the analysis. Before start of the episode 5, let's have a brief overview of the week gone by. Last weekend, we saw the threat of extreme geopolitical risk event in Russia. Some considered it as mutiny, coup or even the early stages of civil war in Russia. But everything got settled before the start of the week. Global markets had taken a sigh of relief and we saw normal market opening across the world. During the week, better economic data from the US made the market believe that July rate hike is almost certain, whereas Eurozone, UK, Japan and China continued to face downtrend in the economic activities. On the other side, Indian economy is continuing to show resilience to global growth concern. With this, let's start our India macro market analysis for the week with episode 5. Let's start first with India economic news and events during the week. India's economic fundamentals are continuing to show resilience to global headwinds. This is further reiterated by incoming data points that indicate robustness in economic activities. During the month of May, bank credit growth continued to stay elevated at 15.4% on the back of personal loan growth and service sector credit growth. Core sectors are growing at consistent pace. Robust rise in direct tax receipts has improved the fiscal deficit. Fiscal deficit is lowered compared to corresponding period in the previous year. India's current account deficit narrowed sharply to $1.3 billion, which is at 0.2% of GDP in the fourth quarter of financial year 2023, mainly due to moderation in the trade deficit and a robust increase in services exports. Capital account balance recorded a surplus of $6.5 billion in the fourth quarter of the financial year 2023 and $59 billion in financial year 2023. Overall, balance of payments recorded a surplus of $5.6 billion in the fourth quarter of financial year 2023 and a deficit of $9 billion in the financial year 2023. RBI, in its monthly bulletin, states that bringing down inflation to its target level of 4% and stabilizing the inflation expectations will revive consumer spending. Revival in consumer spending will boost corporate revenue and profitability, which is the best incentive for private capex. It continued to stress upon the need for a continuous vigil on the price movement. RBI Governor Shaktikanta Das continued to reiterate its focus on bringing inflation to the 4% target, but it has raised some concerns on achieving the target due to El Niño conditions. Further, the governor has shown confidence that the economy will grow at 6.5% in the financial year 2024, as estimated by the RBI earlier. He further stated that despite global growth uncertainty, the Indian economy has shown a solid recovery and is among the fastest growing large economies. He also expressed that financial stability is non-negotiable and all stakeholders in the financial system must work to preserve this at all times. Shashanka Bhide, an external member of India's Monetary Policy Committee, expressed concerns on inflation expectations. He said that inflation expectations may have moderated, but firm demand in the economy could fuel cost and price increases unless supply conditions are flexible enough. He is of the opinion that RBI should avoid making abrupt changes in course, as doing so would disrupt the objectives of both growth and inflation. On the other hand, MPC's external members, Jayant Verma and Ashima Goyal have expressed concern on demand-side issues due to sharp spike in the policy rates, and continuing to keep those rates elevated. Standard and Poor Rating Agency may consider to upgrade India's sovereign rating on the back of improving fiscal metrics, as well as improving India's external sectors along with resilient economic growth. As stated by the rating agency, improvement should be sustained and inflation should continue to stay low. As per RBI's Payment Vision 2025, it is aiming to internationalize rupee. In the past, it has taken many steps that includes allowing trade payments in rupees to enhance the local unit's acceptability globally. Continuing with this vision, RBI Governor Shakti Kanta Das said that RBI is in talks with other major global central banks to promote digital rupee for cross-border payments. Productivity-linked incentives to promote manufacturing in the country is showing positive results, as India's export for mobile handsets have shown significant growth. There are some structural issues in the scheme, on which the government has received feedback from industry and government departments. On the back of this feedback, government is reviewing PLI scheme to address structural problems and snags. It is also looking to extend the scheme to more sectors to promote manufacturing in the country. On the banking side, the sector is continuing to show robustness and able to withstand any adverse economic scenario. Recently, RBI has released Financial Stability Report. The report states that downward trajectory in gross non-performing assets ratio in the banking sector is continuing. Gross non-performing asset in the sector fell to a 10-year low of 3.9% in March 2023. The net non-performing assets ratio declined to 1%. The report also noted that banks are well capitalized and would be able to comply with the minimum capital requirements even under adverse stress scenario. Now let's move to global news and events. Downturn in manufacturing PMI activities across the major economies, Japan, US, UK and Eurozone are bringing concerns on growth slowdown. In US, despite PMI manufacturing activities fell to 43.6 in June from 48.4 in the previous month, and S&P Global US Services PMI also shown moderation to 54.1 in June from 54.9 in the previous month. Strong durable goods data, housing stats, consumer spending, lower jobless claim and upward revision in GDP indicate resilient economic activities in the country. Fed is continuing to maintain the rhetoric on rate hikes. Germany's business climate index worsened further, indicating further weakness in economic activity in the region. Slowdown in economic activities in China. There is an expectation of fiscal stimulus from the Chinese government to support growth in the country. Developed market central banks continue to maintain hawkish stance as inflation worries still lingered. ECB President Christine Lagarde highlighted, it is unlikely that in the near future the central bank will be able to state with full confidence that the peak rates have been reached. What seemed transitory, energy shock-driven inflation has now seeped into the broader economy. Now, let's move to our next segment, market analysis. Let's start market analysis with USD INR. USD INR opened the week flat and traded in the narrow band of 81.83 to 82.20. There was a talk of revolt in Russia during the last weekend. It was expected that due to risk sentiment, capital will fly to safe haven assets. But by the market opened, matter got settled down and there was flat opening in the currency pair. Fundamentally, factors are favoring INR appreciation along with IPO flows, though RBI intervention will keep a check on sharp appreciation in the rupee. Further, rise in dollar index and weakness in Chinese yuan will provide resistance to appreciation in INR. Technically, the currency pair is taking trendline support at 81.90. The next support is at long-term trendline at 81.75 and 81.65 the prices supported earlier. It seems market will continue to move in the zone on 81.65 to 82.36. Break from these levels will decide the next direction in the currency pair. Now, let's move to analyze dollar index price during the week. During the week, we saw uptick in dollar index, though it closed the week flat. Uptick in the dollar index was on the back of strong economic data from the US economy. Positive data from housing sales and prices, upbeat consumer durable goods order, and better consumer confidence data along with hawkish commentary from Fed will push the index higher. Better GDP data along with lower jobless claims has increased the rate hike expectation in the US. The Federal Reserve Bank of New York President Williams stated that restoring price stability is of a paramount importance because it is the foundation of sustained economic and financial stability. Fundamental factors are indicating uptick in dollar index. However, continuous rhetoric on rate hike from Eurozone will keep a check on sharp up move in the index. Technically, dollar index is moving in the triangle. 102.20 and 101.90 are support, whereas 103.7 and 104.10 will be resistance levels. Break from 104.10 will give further direction to the index. Now, let's move to the next asset class, which is crude oil, to understand price movements during the week. Civil war concerns in Russia pushed the oil prices higher as market was worried about supply disruption. For the time being, the risk has been averted, and markets' focus is back on demand disruption due to global growth concerns and continuous rhetoric by central bank to raise interest rate hikes. Rise in prices at the start of the week has been retraced and taken a trend line support at 72.10 zone. After the US crude inventory data, which showed a larger than expected draw in its crude and gasoline inventories, oil prices rose. However, hawkish comments from central banks and economic uncertainties will continue to cap upside move. Technically, 76.55 will be resistance and support at 72.31 and 70.60 level. The Bloomberg Commodity Index shown reversal in upmove as the expectation of fiscal stimulus from China is fading. Index will take a support at 99.85, which is upper trend line of the channel. On the upside, 102.33 will be the support. Better data on durable goods, consumer sentiment along with better GDP print will keep the dollar index higher. That will keep a tab on upside move in the commodity index. Now, let's move to analyze price movement in the gold prices during the week. Gold prices were expected to go up due to geopolitical uncertainty on the news of Russian civil war. At this moment, crisis has been averted, and continuous rhetoric of rate hike put the downward pressure on the yellow metal. Spot gold had fallen to $1,891 on Thursday, before recouping some losses. Strength in the dollar, which is led by positive GDP revision along with strong consumer spending and housing stat data. Comments from Powell on further tightening led to rise in dollar index. Though gold prices traded below 1900 during the week, it closed the week above the support of 1915, which is 61% Fibonacci retracement of the price movement from 1807 to 2080. Downside break will be supported at 1890. Upside move will be resisted at 1940. Any downside break from 1890 will take the gold prices to 1865 levels. Now let's move to analyze movement in Indian government securities. During the week, 10-year India government security yield rose, tracking rise in US Treasuries yield. 10-year Indian bond yield broke the resistance zone of 6.09% and closed the week at 6.11%. We are expecting 10-year bond yield to touch 6.18%. We have seen upward move in 10-year government bonds since the RBI's June policy meeting, as RBI is focusing to anchor inflation towards 4% target level. Market now believe that RBI is going to maintain a long pause, and if any policy rate cut happen, it will only be by the end of this calendar year. Any sharp down move in the yield is not warranted, as central banks across are maintaining hawkish tone. Monsoon progress will be a key to watch out for. We believe up move in the yield is an opportunity to buy as policy rates are peaked. During the week, India's sovereign yield curve has moved upside across the curve. Medium to longer dated curve moved up, tracking rise in US Treasury yields. Shorter dated curve is more tracking liquidity. During the week, liquidity has hardened and the TREPS rates have moved significantly higher to 6.9%. MSF volume has increased from 18.78 billion Indian rupees on 22nd June to 710.5 billion as on 28th June. Whereas SDF volume also has increased from 658.96 billion Indian rupees as on 23rd June to 979.71 billion Indian rupees as on 28th June. Overnight rates have hardened on account of rising liquidity deficit, which is also evident from the MSF borrowing volume. Simultaneously, we can see SDF volume are also rising, which is hinting the skewed distribution of liquidity in the banking system. As seen earlier, RBI always announces variable rate reverse repo auction whenever SDF volume increases, irrespective of overnight rates. Hence, there was no surprise when the RBI announced variable rate reverse repo auction against the market expectation of variable rate repo auction to infuse liquidity to cool off the overnight rates. We believe that soon RBI may announce variable rate repo auction to cool down overnight rates. 10-year US Treasury yield move up during the week on the back of positive data from the US. Despite US manufacturing PMI activities has weakened, strong consumption and improved consumer sentiments along with upbeat labor market keeping the economy resilient to downward forces. There is also a belief that, after the pandemic, there was shortage of supplies due to which we have seen sharp increase in imports to build up inventories. Now, supplies have been normalized and consumers have shifted their consumption behavior towards services. If we look at charts, 10-year US Treasuries broke the resistance of 3.86 and moved up. However, it closed the week below the resistance zone at 3.84%. We expect 10-year US Treasuries to move up on the back of upbeat economic data and Fed's resolve to bring down inflation. We see the next resistance in yields at 4.11%. Let's begin with equity price analysis. In our last week's market analysis, we clearly indicated that Indian equity market is showing better strength than major global equity markets like US, Germany and France. We are correct for that. However, we also predicted that Indian market will be soft, considering the flatness of the Nifty and Bank Nifty weekly chart. Market behaved otherwise and showed huge strength. This has primarily happened because of very high foreign institutional investors inflow in the last two trading sessions. Nifty closed the week at 19,189 and Nifty Bank at 44,747. Foreign institutional investors turned net buyers in Indian market in the March 2023 with a meager 10 billion Indian rupees net buy position. FIIs quickly ramped up to 27 billion Indian rupees net buy in the cash market, both in May and June. However, They increased unusually high volume in cash market on last 2 days, leading to consecutive gap up opening and market attaining new all-time high. Last week saw two important new age technology IPOs in Indian market. IdeaForge, a drone design and manufacturer for use in mapping, security and surveillance purpose, came out with its IPO of 5.67 billion Indian rupees, and it has been oversubscribed more than 100 times. Another new age technology company, signed DLM, a design-led manufacturing, a subsidiary of listed high-end engineering research and design company, signed Ltd, came out with its IPO this week to raise 5.92 billion Indian rupees. It is a design-based electronics manufacturing and services company. The IPO has been oversubscribed by 67 times. Huge success of such IPOs of new age technology companies indicate that the market has very high appetite for technology companies. Investors and traders may expect other new age technology IPOs in the near future, the most anticipated one being Tata Technologies. Nifty uprise was fully supported by global uprise. Dow Jones Industrial Average had a good run on 29th, followed by a gap up on 30th. Likewise, French equity market shows three sharp green candles in an almost gap-up-like fashion, representing 28th, 29th and 30th June. German index, DX, recorded 1.2% increase on 30th June. These events have been marked with a blue arrow in respective charts. This clearly shows that global equity market became red hot in the week gone by. We discussed that Indian market is by far the strongest among major equity markets, and when global markets behaved in that fashion, Indian equity market jumped almost 3% in one truncated week with a holiday on 29th with 3 consecutive gap-ups. Searching for similar strong uprise with consecutive gap-ups in recent past led us to two events. In the last week of July 2022, we had a very similar situation. From consecutive gap-ups, market went up by 600 points before peaking out. Although not consecutive gap-ups, but there were 4 gap-ups in the second fortnight of October 2022, and from there market went up 750 points. Going by such precedents, another 600 points will take us to the range of 19,800, while another 750 points will take us to 19,950. We are at the fifth wave of the larger 5-part Elliott wave, and end of the current wave is not visible. Applying Fibonacci retracement, one can see next place for Nifty to catch a breath is 19,450 followed by 19,750. Echoing the overall global and local market sentiment, Bank Nifty also rose to new all-time high and closed the week at 44,747 with an impressive 2.5% weekly gain. However, the point to note is that unlike Nifty, there was no technical gap up in the last 3 trading sessions, and one of the candle was red. Like Nifty, Bank Nifty is also in the last leg of the current long-term 5-part Elliott wave. The next technical target for Bank Nifty is 45,630 followed by 46,370. Overall market is extremely bullish. Going by past records, Indian stock market has still some upside remaining before it catches a breath and goes into some kind of technical correction. So, here we wrap our episode 5. We will see you next week with our weekly analysis. Till then, bye-bye. Thank you for watching the video. If you have any suggestion or feedback, you can reach us at info@sahasacademy.com or visit our website www.sahasacademy.com. You can also reach us through social media platform LinkedIn, Facebook, Twitter and Instagram. To encourage us to share more videos, please subscribe to our channel. Thank you. Sahas Academy has prepared this report with the guidance and contribution from Dr. Sukhendu Ghosh, Mr. Mataprasad Pandey and Mr. Harish Madan. We want to thank them for their guidance and contribution for the report. Disclaimer: this video is made for educational purposes. It does not constitute an advice. Please consult with your investment advisor before taking any investment decision.